Hey everybody, and welcome to the last video of Chapter 8 and of Unit 2. So today we're going to be talking about the demand and supply model of short-run movements in interest rates. So we're going to first explain what the simplified demand and supply model is in the Forex market. Then we're going to talk about how the supply and demand curve moves, and then we're going to finally put in and impose what we call the interest rate parity condition. So first, the demand and supply model, we're not going to spend too much time here. It's the exact same simplified demand and supply model that you guys have been using for years. Basically, that as the exchange rate for a currency improves, the supply is going to increase and the demand is going to decrease. So the one caveat is you have to remember that we're still dealing with exchange rates, and so we're talking about in terms of one currency versus the other. So when we say the exchange rate increases, that means that the yen to dollar ratio in this case is getting bigger. So you have to spend more yen to get a US dollar. So the US dollar is appreciating and the yen is depreciating. So what now changes the supply curve for currency? First are your normal M1 and M2 measures that we've talked about a bit in the last unit, and then we're going to talk about it especially in unit 4. But demand side moves will also affect the supply curve. And the reason for that is, once again, these prices are always in terms of a ratio. And when we're looking at the trading of two currencies, that means that somebody has to be willing to sell and somebody has to be willing to buy. And so it's really worth looking more in depth at the demand curve for currency, because everything will just be flipped if we want to look at the supply side. So first, and most importantly probably, are changes in market conditions in each country. So for example, when the US in 2018 imposed tariffs on steel imports in China, there was a demand shift to the left of the yen in terms of US dollars. And the reason for that is just because there are no longer US businesses investing as heavily into the Chinese market, so they don't need as many yen. On the flip side, when those tariffs subsided, there was a shift to the right. So these market conditions really have a big role in the Forex market. Additionally, inflation speculation is massive. And so these are people that are now just investing directly into a currency to make a profit when they sell that currency back off. So, for example, a fund thinks that the yen will appreciate in the future. Uh, so they may want to speculate on the Chinese market by holding yen. If they think that inflation is going to drop or US inflation is going to increase, they might want to hold on to more yen in hopes that the yen will strengthen. And so now we just have a graphical illustration of this. So as we can see in the first graph, we're talking about a demand for US dollars in exchange for yen shifting to the right. So we're looking at an increase in investment, for example. Then on the flip side, there's going to be a shift for US dollars because more people are trying to sell their US dollars. So this is the yen market, and this is going to be the dollars market. So, a pretty simple concept right there. Like I said, the big thing you have to really remember is that we're always talking in terms of a ratio with this. Now, one last concept for you before we close out this conversation, and that's called the interest rate parity condition. And most Forex participation, it all just comes down to an increase in international capital mobility. As people start to increase their interest and desire to invest in foreign markets, Forex market has grown exponentially. But there's one big condition that we're going to have with this is that uh, the differences in interest rates on similar bonds in different countries reflect expectations of future changes in exchange rates. This is the big takeaway from this chapter. But there are some drawbacks, and we're going to get to those in a second. But basically, the idea is that if we're looking at, a 10-year bond but issued in the US versus issued in Germany, there are some differences in domestic risks, etc. But the big difference between what the interest rate would be on a US Treasury bond versus a German bond is exchange rate risk, which is the risk an investor will suffer losses on international investment because of fluctuations in exchange rates. So, especially that's going to come from uh, inflation risks, etc., that may move a country or a country's currency relative to a different one. And so we can calculate this actually out as the interest rate on a domestic bond is actually equal to the interest rate on a foreign bond minus expected domestic appreciation. And so once again, we have this study of two different currencies and looking at each other. And the idea is that since the US may go into a period of inflation in the near future, then by investing in the US Treasury, you're putting yourself at a risk of the US dollar depreciating in value as inflation rises. And so the only reason, according to the interest rate parity condition, that a US Treasury bond would be worth more than a German bond is this exchange rate risk that is primarily derived out of inflation. But as I mentioned, there are several problems with this condition, but it's still an interesting result that's worth considering. First, that default risks are different in each country. So, for example, according to this interest rate parity condition, the only difference between investing in US bonds and Venezuelan bonds is the difference between the two currencies. However, the Venezuelan central government is on the very close to defaulting on their currency, so the default risk is not at all the same. Additionally, there are massive liquidity risks associated with investing in different currencies. So, there's not as much desire to invest in Curaçao's bond market as there is in the US bond market. So you may lose liquidity by investing in Curacao bonds. Additionally, transaction costs can be quite high to enter the Forex market because usually you get a bit of double dipping. There's going to be some sort of premium you pay on the Forex market. And then since most people can't directly enter into the Forex market, they have to do it through a financial intermediary, then that intermediary is also probably going to pay you some cost to enter into the Forex market. So these transaction costs limit any arbitrage smoothing. Finally, uh, exchange rate risk is always going to exist, which means that we're never going to have parity between two different types of bonds based in two different currency markets. So some limitations, but still a useful result to consider, especially when you're considering bonds of similar types, such as I mentioned, the US and Germany. So with that, you have finished Unit 2, and you should be now getting ready to take your first midterm.